term professor in economics finance, and this event is joint hosted by Department of Economics, the Center for Quantitative Finance, the Institute for Mathematical Sciences, or at NUS, National University of Singapore, and the Monetary Authority of Singapore. And my name is Stephen Koh. I'm from the Center for Quantitative Finance. Welcome, everybody. And today is a great honor to present our speaker, Professor Darrell Duffie, who is Dean Wicher, Distinguished Professor of Finance at Stanford University. And of course, Darrell is one of the most famous finance professors in the whole world, with need no introduction at all, but just a few brief words. If you go online, look at Darrell's webpage on CV, immediately notice on the first few sentences something extraordinary. For example, he got a PhD in engineering economic system, which is more like operation research management science. Then he immediately got a job as assistant professor at the Stanford finance department. That's very extraordinary because you get the degree in kind of management science operation research, but then you get teaching job immediately at same school, but finance department. For those of you who are not familiar with the U.S. Academic system, it's extremely difficult for somebody who just graduates with a PhD get the same job at the same university, unless the person is extremely good. And secondly, for those who are not familiar with all these areas, Professor Duffie got the degree in OR, right, more or less. And it's very difficult to get into finance, right? Imagine, suppose you're a statistics professor or mathematics professor, you submit a paper to Journal of Finance, you see what I mean, right? Okay, so it's extraordinary. Now, Professor Duffie has been at Stanford ever since then, and he has many honors, just to give a few. For example, he's a fellow of Econometric Society. He's a member of American Academy of Arts and Sciences. He's also a member of Federal Advisory Roundtable of Federal Reserve Bank of New York. And also in 2009, he was the president of the American Finance Association. In 2003, Professor Duffie was awarded the Financial Engineer of the Year from the International Association of Financial Engineers. Now, Professor Duffie has read many fundamental papers. For example, for people who are familiar with derivatives, his paper on alpha and gamma diffusion models, credit risk modeling, all the classical papers. For people who are in theoretical economics, his early work on equilibrium are all also classical, and also his writing also very timely. For example, a few weeks ago, we heard this Chinese banking crisis, sort of banking crisis in terms of interbank lending, and Professor Duffie has a paper on that, on repo rate in particular, back in 1996 in Journal of Finance. So that's way before anything happened right now. So he already foresee what happens in some cases. Now, most of us try to aim at writing one or two papers, but Professor Duffie wrote many books. Of course, the book, which is the classical book, the dynamic asset pricing. But if you look at last 3 years, he wrote one book every year. For example, in 2010, he wrote a book on How Big Bank Fails, published by Princeton University Press. 2011, Measuring Corporate Default Risk by Oxford University. And 2012, last year, Dark Markets by Princeton University Press. Every year, a book. Okay. So I have a personal story about one of Duffie's books. So 1995, I become assistant professor at Rutgers University. Then I taught a PhD level course on asset pricing. So, of course, at that time, there's no book except Professor Duffie's book. So I used his dynamic asset pricing as a textbook. So immediately, after my first lecture, one of PhD students in the department came, said, okay, look, I read the first pages, I cannot understand anything because it's all full about the vector space, Heim-Bankner theorem. I have no idea. Okay, then I told the PhD student, I said, look, this is a book like a classical Chinese poetry book. You're not supposed to read during bedtime. You're supposed to read 2 sentences, try to appreciate that, then try to read again in 2 weeks, slowly, okay. Then I give her an example. I said, look, so at the very beginning, I only understand the 4th sentence of Professor Duffie's book. In your book, there's a definition of arbitrage. first two sentences for buyers, the next two sentences for sellers. Then, of course, one of my advisors, this paper is about hedging about seller's price. So I wrote paper as PhD thesis about both buyer seller's price and the price in between. So essentially, my PhD is taken from 4 sentences from Professor Duffie's book. Okay. Then I told students, imagine, okay, you can write a paper if you understand 4 sentences, if you understand the whole book. Okay. Then, so I said, okay, again, this book you have to read as a poetry rather than a popular novel book. 2 weeks later, the student came back to me and said, no, Professor Duffie can also write a popular novel book. I said, what? He said, okay, he has a book on futures market, has no math at all. Right? So I think what I'm trying to say is no one is more qualified to give a public lecture to convey the very complex financial theory, mathematics, to general audience without using any mathematical terms. So without further ado, let's welcome Professor Duffie.
I think that's the first time I've seen any comparison of finance and classical Chinese poetry. I'm honored to be associated with it. Stephen and I have known each other for many years, and he already knows how highly I respect him, but I'm not going to inflict on him what he just did to me. So I see many of you I've already met. I'm looking forward to meeting the rest of you. I hope we'll have a lot of fun. This is supposed to be fun. This is not math today. There is some math behind all this, but that's not my purpose today. I was told this was to be a general public lecture, so I'm going to talk about some policy issues related to changes in the banking system that are currently being discussed, at least in the United States and Europe, and possibly in Asia as well. I'm actually going to go to Shanghai and next week find out more about Asian banking markets in China at least, and see what they're planning. But this is all about basically the boundaries of what defines the banking system from a regulator's viewpoint. And I hope it will generate some discussion. Okay, so we're talking today only about the core of the banking system, meaning the largest banks, which are interconnected with each other and which provide various services to the economy. So I want to focus for actually quite a while on this simple diagram of what we think that banking services are and what banks do for us. And then later we'll talk about which of these services are permitted to occur inside the banking system and which ones are forced to occur outside. That's one of the main issues going on in Europe right now and in the United States. We have famous names like Volcker, the former Federal Reserve Chairman, Paul Volcker, Liikanen, the governor of the Bank of Finland, and Vickers, John Vickers, who has headed the Commission of the United Kingdom on this issue. So these 3 names are associated with trying to draw boundaries around these activities. What goes inside is permitted, what goes outside is not permitted. Okay? The final rules regarding this are just being formulated. In the United States, the law defining what's permitted has been passed by Congress, but the rules for implementing it still need to be written. Now, more than 3 years after the law passed Congress, the rules are still not been written. We have some chance maybe to influence them. And in Europe, even the basic laws are still being discussed. Probably next year we'll know what they say. So here we're going to start with the most important, in my view, the most important function that the banking system provides to the economy. I wonder if this is a laser pointer. Do we have a laser pointer? So, the core activity is payments and settlements. What does that mean? Well, let's go back to, I'll come back to this diagram. Let's talk about some customers of these banks. So suppose, for example, Bank 1 is trying to adjust the positions of its clients. It's going to use the interbank system to do that. Adjusting positions means moving risk, like with derivatives, buying and selling securities, taking deposits. The payments and settlements function is basically allowing the customers of these banks, like Bank 1, to conduct transactions in the economy. So suppose, for example, let's take your favorite car company, Toyota. Well, suppose you want to buy a shipment of cars from Toyota here in Singapore. What do? You have to get the money to Toyota. What do? You call your bank, like if you're a customer of Bank One, and you say, please, would you take out of my account and put in the account of Toyota Motor $50 million for cars. And so Bank One will take the money out of your account, and it will send a message to Bank Three, which is Toyota Motors' account in Tokyo, and they will say, here is $50 million. Please put it in the account of Toyota Motors. Bank 3 will conduct that transfer. So we can't pay for cars unless we have banks to make these payments and to settle transactions. That's also true if you're paying for treasury bonds or if you're settling a tax payment. Any kind of payment that's made other than with cash out of your pocket, essentially any kind is made through the banking system. Okay, so if we don't have banks, we can't run the economy. Impossible. So if banks fail, and this is the point of today's lecture, if banks fail, we don't have this core function of payments and settlements with which to run the economy. We all, in page 1 of these textbooks that Stephen was mentioning, we kind of take it as obvious that when you pay for something, the money gets there somehow. You need the banking system to do that. Okay, that core function is one we want to protect. And because of that, we have a lot of regulations. We have reserve requirements. We have risk-taking requirements. We have capital requirements. We have liquidity requirements. We have all kinds of disclosure requirements. Many, many, many regulations that are designed to protect the payments and settlement system. One of the most important things that we have to protect it is called deposit insurance. What does that mean? It means that if a bank runs low on capital, the depositors in that bank don't need to run to the bank and get their money out right away because those deposits are insured. If we didn't have deposit insurance, people would often run to the bank, take out the money, and cause the bank to fail. That's why we have deposit insurance, and it's why some of these other activities, like trading securities and derivatives, making markets, underwriting securities, and providing long-term loans. Credit provision with maturity transformation means long-term loans. That's why in some banking systems, these activities are not permitted inside the bank. They have to happen outside the bank to protect the payments and settlement system from risk. So if we don't have, for example, it's been suggested in the United States that if banks do not do trading of securities and derivatives, they'll have less chance to fail, and therefore less chance that the payments and settlements functions of banks will be interrupted, less chance of harming the economy. Everybody got the idea? Ask any questions anytime. So this is the motivation behind these rules that restrict banks for performing certain kinds of activities. And what we're going to discuss is what stays in, any of these, and what goes out. Okay? We're drawing boundaries. So think of yourself as a policy regulator. You're going to take a pen and you're going to mark this diagram. What you think should be permitted on the inside of the banking system, everything else goes to the outside. That's the exercise for today. In the next, you said an hour, so now next 45 minutes or so, yeah? And then we'll take Q&A if there's any time left. Okay, get your pen ready. Okay, here is the narrowest possible definition. It's called a narrow banking system. And it has been seriously proposed by a number of economists. It's rarely been adopted in practice. An example of a very, I think, appealing argument in favor of only allowing deposit taking is one offered by George Panacki, who's a financial economist at the University of Illinois in Chicago, in Urbana-Champaign. The advantage of this one is that these activities of doing payments and settlements are not very risky. You put in short-term money, it sits there, and when you're ready, you take it back out. The chance of losing money is very low. It performs the minimal functions. So all of these other things in a narrow banking system would happen outside. The outside is sometimes called the shadow banking system because these are banking-related activities, but they don't happen inside the banking sector, they happen in the shadow of the banking sector. Now, personally, I would draw the boundary wider than that because there's a lot of synergy, a lot of positive externalities associated with allowing some of these other activities like long-term loans to happen in the same place where you do payments and settlements. Banks are very good at offering loans, so perhaps from an efficiency viewpoint, they should be allowed to do that. I'm going to make an even more powerful argument later, which is that these other activities that happen out here, trading securities and derivatives, long-term loans, and so on, when they fail, even if the payment and settlement system survives, the economy can still crash. Okay, when securities markets, for example, have a crash, that can cause damage to the macroeconomy. Maybe there's something about the banking system that can help mitigate the impact on the macroeconomy when these other activities crash too. Okay, so I'm going to talk about that. Included in that area is the very strong supervisory regulation that's provided to the banking system that's not provided on the outside in most banking systems. Access to the central bank for lending of last resort. Strong capital and liquidity requirements that are set on an international basis. Those protections are not available, or at least as strongly available on the outside of the banking system, so perhaps some of those activities should be permitted on the inside. That's the trade-off we're going to be talking about. Safety on the inside of the banking system is not the only goal. Efficiency and safety on the outside of the banking system is also important. Recently, for example, in China, there's been a lot of discussion about dangerous shadow banking activities that are not inside the banking system, and the efforts of the Central Bank of China, the People's Bank of China, to control that kind of risk-taking. If it were inside the banking system, it might be easier to control. Here is the opposite place. So some of you have your pen ready. Maybe you drew a circle around everything. This is called the universal banking system. This is the most popular approach in the world today, but it's undergoing revision. In Europe, most parts of Asia, with some variations, all of these activities, and sometimes even including insurance, which is a banking-related activity, are conducted or allowed to be conducted by banks. It doesn't mean that all of these activities are always conducted by banks. It means that banks are permitted to conduct all of these activities. That happens, as I said, in most jurisdictions, and it was the case in the United States until, or I should say, between 1999 and 2010. Before 1999, the United States did not permit these derivatives and securities markets trading activities inside the banking system. That was called the Glass-Steagall Act. It was a separation of investment banking activities from commercial banking activities. After 1999, that was eliminated, universal banking was allowed, and then the financial crisis of 2008 and 9 happened, and Congress decided, well, maybe something about the Glass-Steagall Act was a good idea. They didn't go back to Glass-Steagall. We'll see what they went to in a few minutes. They went to something called the Volcker Rule, suggested by Paul Volcker. Now, maybe I should mention briefly, over history, if you read, for example, the book by Carmen Reinhart and Paul Rogoff, the most frequent cause of crashes in the banking system is not actually these activities over here, related to securities and derivatives trading. It's related to maturity transformation, by which banks lend money for long terms to borrowers who often can default. sovereign nations, real estate developments, large corporations. When these loans fail, the banking system crashes. Real estate is the most frequent cause, real estate loan collapse, most frequent cause of banking crises. So an interesting question is, if we were to allow some of these riskier activities, which ones would you allow? No one currently has proposed to disallow long-term credit provision, called maturity transformation, and allow underwriting, market making, and other securities trading. That has not been proposed anywhere. So some of you are thinking, maybe I should draw my pen, take my pen, draw here, here. Think about this as a decision to make. What's special about these trading activities? The special thing about them is not just that they're risky. Long-term loans are also risky. The special thing about trading is that it demands a lot of liquidity. That is, you can find yourself in the situation that Bear Stearns had, with $15 or $20 billion in cash available on any given day, until suddenly Bear Stearns' cash disappeared and it failed the next day. Actually, it wasn't failed, it had to be acquired by JP Morgan, but it would have failed on that weekend. Same thing with Lehman. Lehman had a lot of liquidity, and then it suddenly failed. Same thing with Morgan Stanley, had a lot of liquidity, and it would have failed had it not been for central bank lending of last resort. These banks conducted trading activities where sudden demands for cash could cause the bank to fail. That's what's distinct between these trading activities in this region here from long-term maturity transformation, which usually doesn't cause a liquidity problem. Liquidity problems happen in the short-term deposit taking and in the risky trading activities. That's where the liquidity risk lies. We can talk more about why trading is so demanding of liquidity, but it has to do with daily mark-to-market, collateral or margining, derivatives payments, things like that. Leverage also. Okay, so as I mentioned, when you think about where to draw the boundary, remember that central banks in some countries are only authorized to provide emergency liquidity to banks. In the United States, since the financial crisis, since the passage of the Dodd-Frank Act, it is now illegal for the United States Federal Reserve to lend money to a non-bank. That's interesting. Before that, under its emergency lending authority, the U.S. Federal Reserve could lend to any non-bank. Now it may only lend to banks who can then further lend to the economy. Maybe I'll skip this slide in the interest of time. Or the central bank can lend to a large collection of non-banks under special programs. Broad programs are okay. No more lending to Lehman. It's illegal now, or if Lehman existed. An individual non-bank may not receive emergency loans from the central bank. So now think carefully about creating, let's go back to this picture, think carefully about creating financial institutions that do securities trading outside of the banking system that may suddenly need liquidity and no longer have the ability to get liquidity from the central bank. There's a trade-off, of course, because when they know you can get, when you are a trading bank and you know you can get liquidity from the central bank, maybe you take more chances. It's called moral hazard. But there's a trade-off. In my view, any large, risky trading activity that could cause systemic risk on the outside of the banking system may need to have liquidity. 1 second, Paul. May need to have liquidity from the central bank in order to reduce the chance of a deep financial crisis. Paul?
Yeah, I mean, it is clear that your circle and repealing the Glass-Steagall Act really has an implication of moving, let's say, investment bank out of the banking system. Is that a causal Or can
You mean if it's illegal, will it actually happen?
No. If it's done as a consequence that it has to be outside of the banking system rather than be separate from the retail bank.
Well, we're going to get to that, but first of all, we have to discuss how effective these laws are. But under the Glass-Steagall Act, at least for some time, it's true that the commercial banks were not permitted to and did not conduct securities trading. They were conducted, or derivatives trading, those were conducted by only investment banks. Okay, so I'm going to talk about, well, one of the types of activities associated with trading that's operated by banks called prime brokerage that can be very demanding of liquidity. And then we can discuss why this might better occur inside the regulated banking system, or at least have lending of last resort from the central bank. So I know some of you have worked with trading companies or banks. A dealer bank, which is a large bank like Goldman Sachs or JP Morgan or Bank of America or Standard Chartered, HSBC. There's about 15 of these large global dealer banks, some operating here in Singapore. These provide services to hedge funds called prime brokerage, hedge funds and certain other asset managers. And some of these services are things like account keeping, trading execution, tax reporting, risk management, information, lots of things. The one I want to focus on is the account holdings of these hedge funds of cash and securities that are held on account at the bank. Now, why is that significant? It's significant because in order to provide liquidity to the hedge funds and leverage to the hedge funds, the banks offer the hedge funds the option of giving them cash loans if the dealer bank is allowed to send the securities to another investor and finance itself with those securities. So let's have a little role play. Jean-Pierre will be my hedge fund. Is that okay, Jean-Pierre? Absolutely. And Paul, you can be my third-party investor. And Jean-Pierre says, I want to take some risk. I need some leverage. Can you lend me some money if I use treasury bonds or equities as collateral? And I said, well, if you let me hold these securities as collateral, I can give you some cash, but if you allow me to lend the securities to Paul as collateral on a loan from Paul to me, then I can give you even more cash, so you can make more leverage, take more risk. And Jean-Pierre says, fine, I can do that, because there are rules, hopefully, that will protect me. Now the dealer bank is using these securities as a source of financing to the bank itself so that it can provide financing to its clients. There are rules in the United States that restrict this to a certain extent. In the United Kingdom, in London, which is the world's largest banking center, there are no regulations. It's purely a matter of contracting among the three of us. No overall market regulations. Let's see what happened around the period of the failure of Lehman. Before Lehman failed, Morgan Stanley, which was one of the largest banks, trading banks, investment banks, had around $900 billion of securities that were pledged to it that it was permitted to pledge to others. In this transaction between Jean-Pierre permitting me to pledge securities to Paul, the aggregate amount of that at Morgan Stanley before the failure of Lehman was about $900 billion. After the failure of Lehman, it dropped to immediately about $300 billion. What does that mean? It means that if this is Morgan Stanley now has $600 billion less in securities available to it to pledge for cash to Morgan Stanley. That's a substantial reduction in liquidity to Morgan Stanley. Remember what I said about trading activities are very demanding of liquidity. This is a situation in which a sudden change in markets, not a loss by Morgan Stanley, but a sudden change elsewhere in the economy, can cause a drop in liquidity to Morgan Stanley by which it loses access to financing. Let's look at the numbers. How much did it lose? Its cash before the failure of Lehman, $180 billion in cash. When I say in cash, that means the amount that it could send on a given day to pay for anything in cash. That's the Friday before. The Monday a week later, 10 days later, so that includes 2 weekends, it's basically 1 work week. That amount had dropped by $85 billion to $90 billion. So Morgan Stanley lost a lot of liquidity across the week during which Lehman failed. Apparently, a lot of that was associated with prime brokerage losses. 56 billion of that loss in liquidity that's not a trading loss, that's a reduction in cash availability. It's a liquidity cost, not a loss, not a profit or loss. But it's a reduction in financial flexibility that was very important and caused Morgan Stanley to ask for special help from the Federal Reserve, the U.S. Central Bank, and it got massive lending of last resort from the Federal Reserve. In fact, we only have this information on this slide because of a Freedom of Information Act request by Bloomberg that required the disclosure of this information. Of this amount, 45 billion was in New York, where we did have rules. That's quite surprising because there are rules that limit the use of liquidity by prime brokers in New York. And only 18 billion was in London. What happened? Why was there such a reduction? Well, you can see that many of Morgan Stanley's clients disappeared. Their prime brokerage clients went away. They took their securities with them. They did not permit Morgan Stanley anymore to use those securities for financing because they ran away. Sudden loss in liquidity. This is why, as I mentioned earlier, some have proposed separating the banking system, which is now we draw the line here, from securities trading and derivatives trading. This is the Glass-Steagall system that existed in the United States between 1933, which was the end of the last financial crash, and 1999. Currently, the United States is doing a hybrid, which is called the Volcker Rule. This is now law in the U.S. that some of these trading activities are permitted. Underwriting, which means assisting with the issuance of new securities. Market making, that means when Jean-Pierre calls me and tells me he wants to sell me $10 billion in equities, I immediately buy them from him at the right price for me. That's called market making. I offer a bid and an offer on any traded financial instrument to any client at any time. That's called provision of immediacy or market making. That's permitted under the Volcker Rule inside the bank. Hedging. I can reduce risk by trading. That's allowed. What's not allowed? Other trading, that means trading which has none of these purposes other than to generate profit. So if I'm purely trading for speculative purposes and do not have in mind underwriting, market making, or hedging, that's no longer legal in the United States. Any questions about what that law means? That's called the Volcker Rule. It's part of the Dodd-Frank Act. Yes, Bob. Well, that's one of the key questions is what exactly, how do you define a hedge and how do you define market making for regulatory purposes? What's the definition when enforcing this law? And those implementing definitions are still to be written because they're very, very difficult. Okay, so hedging, well, I could say when, for example, in the famous losses of J.P. Morgan, so-called whale trading losses, initially J.P. Morgan said, it's okay, this was hedging. Now people are not so sure. It's very hard to define hedging. They said, well, it's macro hedging. We're hedging against a general downturn in the economy. How do you define that precisely? Also very hard to define is market making, and that's the one on which I want to focus for a few minutes. Remember, market making is when I provide immediacy to Jean-Pierre. He calls me, he wants to sell something or he wants to buy something. I say, sure, I'll buy it, and then maybe I can make some money, and later I can sell it to Freddie in the back row. And I can profit from the difference in price at which I bought it and which I sold it. Sometimes I make money, sometimes I don't. On average, I try to make money. That's called market making. Now, it's very hard to define that because the regulator, Steve, you can be my regulator today because you're wearing a suit. The regulator comes by and says, oh, those $50 million of equities that you bought from Jean-Pierre, weren't you speculating that the price would go up? And I said, well, I was making markets. Jean-Pierre wanted to sell them, I wanted to buy them. And Stephen says, well, didn't you then make money? You bought them from Jean-Pierre at $50 million, you sold them to Freddie at $60 million, you made a $10 million profit. Isn't that speculation? And I say, well, yeah, I was hoping the price would go up. That's why I bought them from Jean-Pierre, that I'm hoping I could sell them again at a higher price. That's, I guess you could call it speculation, but I was making markets. And Stephen says, well, can you prove that you were doing this to offer a service to Jean-Pierre, or were you simply speculating? And I say, no, I can't prove it. Maybe I can take a lie detector test. So this is why when the initial implementing rules, the defining rules for hedging or market making were written 2 years ago, the United States agencies charged with enforcing this, including the Federal Reserve, the Securities and Exchange Commission, the Commodity Futures Trading Commission, the Office of the Comptroller of the Currency, they came up with these proposed rules for defining, Bob's question, market making and hedging, and they got 17,000 comment letters and submissions, most of them criticizing the defining rules, the rules that say this is what we mean by market making, this is what we mean by hedging. In fact, I made my own submission because I didn't agree with their proposal, and I'm going to explain why in the next few minutes. Okay? Here's roughly what the rules regarding market making were intended to do. They were intended to draw a defining line, that's the dotted line, where on the left side would be permitted trading like market making, and on the right side would be the forbidden trading, not market making. Now, some of this stuff over here is clearly, demonstrably not market making that the banks were doing. Like, they had internal hedge funds. They had a whole floor, some of you know this because I know you work in banks, a whole floor of the bank where they didn't do anything but figure out how to speculate. They weren't working with clients, they were just devising trading strategies to make money. It's not an evil occupation, but it's clearly not market making, it's not hedging. We can easily say that floor, the 23rd floor, those guys have to go. Okay? Now, also on the right-hand side, in forbidden territory, is a lot of other stuff, including some stuff here that is really market making, but it's hard to prove. Just like when Steve was interrogating me a moment ago, maybe Jean-Pierre really was interested in having me get rid of these securities for him, and I decided to offer that service. But it's going to be very hard to prove it. And the rules that the Federal Reserve and the other agencies suggested were cutting very hard into stuff that was really market making, but was hard to prove. There is stuff that is demonstrably market making. What's called flow trading, where you set a bid-offer spread that's narrow and you just leave it there, and any small trades that come along, you scoop them up. But then there's also risky market making that could be speculation. Let's look at an example. When I made my submission to the U.S. government, I decided to collect data from a large U.S. dealer bank, anonymous. I'm not going to be able to tell you who it was, but it's one of these big ones. And I said, okay, by the way, I did this for all of the securities in which they made markets, all of the equities and corporate bonds. And my submission, if you want to get it off my website, it has some of the average statistics. I'm only going to show you an example for how much of the inventory, what was the inventory of this dealer bank of a particular security. This particular security is equity in Apple, which is the computer company. Okay, so here's what happens. Where's my marker? Okay, when my inventory is near zero, Jean-Pierre calls me, and woo, here's another spike here. Big jump in my inventory. Why? Because I offloaded. Jean-Pierre sold to me a big chunk of equities, and then over time, I sold a chunk to Freddie. Maybe somebody called me again. I took some more. I sold some more. Eventually, I try to get it back to zero. The mean reversion of equities inventories for Morgan Stanley was at a very high rate. The half-life was something like, if I remember, 7 days. The half-life of decay towards zero, or the average mean. In the corporate bond space, same idea. This is the same dealer bank. This is a corporate bond, investment grade. Same kind of behavior, but corporate bonds are much less liquid. So I had to keep them on my balance sheet for a longer period of time, which means I'm exposed to risk for a longer period of time, which means bid-ask spreads are larger and expected profits per unit of risk are higher than in the equity world. Here's what happens when someone tries to sell a lot of securities in a short time. Even with robust market making, you will see a sudden drop in the price of securities. Now, it'll take me a minute to give this example, and then I'll try to go quickly through the rest. What is this example? This is the average path of the change in price of equities that are deleted from the S&P 500 index. So remember, the S&P 500 index is roughly the largest 500 U.S. equities. Every once in a while, Standard & Poor's says, these ones are no longer in. We're taking them out of the index. What does that mean? It means that every index investor in the world that's matching the S&P 500 must sell those securities. It's not optional. At least if they're doing their job right, they're supposed to track the S&P 500. They will sell those securities immediately. So what's the price impact? All of those sales caused the price to go down on average across this period, 90 to 2002. On average, across, there's 64 deletions in this data set. On average, the prices go down by about 15%. That's not basis points. 15%. And that's within a few days. And then over time, most of the price is recovered. What is that? That's Jean-Pierre running an index fund. He says, oh, this stock got deleted. He calls me for a price. I know it got deleted. I know everybody else is going to call me. I offer him a price that's really low. Why? Because I'm standing behind a big movement against this equity. I need a nice low price because I'm going to be holding a lot of risk while everybody like Jean-Pierre is selling to me. And meanwhile, I'm calling Freddie saying, how would you like to buy this security? And I'm calling everybody over here trying to get rid of them. And eventually I make quite a lot of money. But I took a lot of risk. By the way, the Sharpe ratio for this trade is not that great. The average path is very good. But there is a reasonably good Sharpe ratio, but it's not this is just the average of the path. There's a lot of risk here too. So I need to be compensated for taking this risk, and I get compensated by buying at a low price and selling at a high price. This is exactly what the agency's first try to write the Volcker Rule failed on. They said, if you are making markets, you should only profit from fees, that is, not price appreciation, fees, commissions, bid-ask spreads, not price appreciation. If you are trying to profit from buying at a low price and planning to sell later at a higher price, we will not call that market making. That's what they said. Now that's not the final rule because everybody protested, including me, saying this is doing what I said earlier. This is taking a lot of actual market making and forbidding it, which will make U.S. securities markets and derivatives markets less liquid. Moreover, if you force risky market making out of the banks, where is it going to go? It's going to go to the exterior of the banking system. Remember, it's very demanding of liquidity, and if a large non-bank gets into trouble, remember, it no longer has access to emergency liquidity from the central bank. So if it crashes, like Lehman crashed, the economy would suffer like it did when Lehman crashed. It won't happen unless there are very large non-banks that are doing a lot of risky trading. That's exactly what the Volcker Rule, as proposed, would result in, and that's why I protested. It would also harm market liquidity over the next 5 or 10 years as the financial system adjusts to deal with this non-bank market making. Eventually, large non-bank market makers would grow up and they would provide the missing liquidity. The markets will become efficient again, but on the outside of the banking system, they'll have large sources of risk-taking that could be a systemic risk problem. So remember the law of unintended consequences. What was the Volcker Rule supposed to do? Reduce systemic risk. My prediction is that, as proposed, it would increase systemic risk. Also, a lot of foreign governments like Japan, Canada, the United Kingdom, and the Eurozone, maybe Singapore, called the United States regulators and said, "We protest. You are harming the liquidity of our government bond markets. When somebody wants to buy or sell a lot of our government bonds, there won't be robust liquidity provision by bank market makers. There are no large non-bank market makers left. That's not good for us." And these countries also said implicitly, "We noticed that when you wrote the Volcker Rule, you provided an exemption for U.S. Treasury securities." And that's not an accident. The Treasury's Debt Management Office would not have stood for a law that eliminated robust market making for U.S. Treasuries. Here's another example. This is the average price path for equities around the time of a secondary offering. This means another issuance of equities into the market, a primary issuance where the corporation, let's say it's, what's a large Singapore corporation? Have any large companies here? Sing Telephone? Okay, so the telephone company wants to issue a lot of stock. What happens to the price path? If it's like the average of these other companies, this is 3,850 all secondary offerings that whose data were available between 86 and 2007 from a study by a Swiss PhD student named Jan Peter Kulak. This is the average price path. What happens to the price? This is the date on which the announcement is made for the size and date of the offering. This is the offering date. This is the offering price. This is the average price path in the secondary market. Notice what happens. Coming into the offering, the price goes down on average. Coming out, it goes up. Does it remind you of this picture? Why? Because the company is selling a lot of securities on this date. The only people that are providing liquidity are going to need to provide liquidity at a low, they're going to need to buy at a low price in order to take the risk and eventually lay off the securities later at a higher average price. If you don't have robust market makers, then these prices will go down further and recover more, and the issuer will suffer a deeper discount at the offering. Likewise, if you don't have robust market making by banks, when a large block of equities is sold, the price would go down even further and take longer to recover because there's less robust market making. So these are harming liquidity. Here is the U.S. Treasuries market. This is in yield space. Remember, yields move opposite direction to prices. This is the increase in interest rate on U.S. Treasuries around the time of the auction, that is the issuance of Treasuries. 2 years, 5 years, and 10 years. The yield goes up about 2 basis points from 5 days before the auction to the day of the auction, and then it goes down about 2 basis points on average after the securities are issued. Why? Because there's a whole big supply of new securities coming into the market. Liquidity providers, market makers, and others need to be able to buy at a low price so that they can take these securities. We don't have this in standard asset pricing models because we assume the price is given in our standard models, and that it doesn't matter how many you sell, the price will stay the same That's not what the real world is like. The real world, the more you sell, the more the price gets pushed down. And if you don't have robust market makers, that effect is exaggerated. There are some mathematical models of this, by the way, for so-called large trader models. If anyone's interested in any of the literature about this, send me an email and I can send you some of the related literature. Okay, here is this first definition that was provided by the U.S. regulators. First attempt. Market making and related activities seek to generate profit primarily by generating fees, commissions, spreads, and other forms of revenue that are relatively, though not completely, insensitive to market fluctuations. The rules also said if you're taking a lot of risk, if you have sudden increases in risk, it's not permitted market making. It's against the law. Those rules will be rewritten. The agencies can't even agree among themselves in the United States about how to define market making and hedging. They're having disagreements even among the regulators. They cannot agree because it's a very difficult thing. Going back to this picture, this separation is very difficult. It's creating a lot more problems than it's worth. It will have unintended consequences. Number one, for the next 5 or 10 years, reduced market liquidity. Number two, eventually the growth of large non-bank market makers whose failures will present greater systemic risk, or could at least. It's an experiment which in my mind we do not need to run. And that's why I wrote a submission about this. This is the European approach. We allow banks to do everything that banks were doing before. So you have two colored pens now to draw on this diagram. The outside circle is what you draw for what's permitted inside the banking company. It's still a universal bank. But there's a separate protective barrier on the inside called a ring fence. This protective barrier is a firewall to protect the traditional commercial banking activities like deposit taking and some lending, to protect those activities from these risky, liquidity demanding activities with special rules that say these activities in here have their own pool of capital. These activities out here, the losses cannot take capital away from the inside. That's called ring fencing. It's somewhat better than the Volcker Rule. I think better overall is to have universal banking with much higher capital requirements. Okay? Increased capital requirements for the universal bank. I think that's my preferred approach. Why? Well, it doesn't have unintended consequences associated with the Volcker Rule, and it's a more efficient way of treating these risky activities is to give them a very large common pool of capital, diversification. It's also the case that if you have one of these universal banks that suffers a lot of losses out here, in my view, let's think in your, I don't want to cause a bank run, but think in your mind, what's a large global bank? What's going to happen to that bank? Maybe think of a bank in London or Germany. What would happen if it lost a huge amount on trading? Do you think the depositors would just wait and see what would happen? I don't. I think they would be prudent. They would take their money out of the bank, even out of this bank, even though it has a protective firewall. And no bank can withstand a depositor run. They're not built to withstand that at current capital requirements. Better is raise the capital requirements for everybody so as to lower this risk. The same thing, by the way, goes in the opposite direction. As I mentioned, in most cases, banking crises are caused inside the lending side of the bank. If there's a huge loss on the commercial loans of a bank, the counterparties in the derivatives market, the repo counterparties, securities lending counterparties, anyone that has the ability to run will run. These protective barriers are not going to be effective, and they're very expensive from the viewpoint of market efficiency and the use of capital. Increase the capital requirements and eliminate the firewalls. I don't feel as passionately about that, however, as about this problem. This is a of the various proposals that have been made, this is the least attractive in my view. This is all by way of judgment. We don't have, at this point in time, sufficient modeling ability to prove any of what I've suggested. This is all judgment based on an understanding of what these activities are, how the banking system works. No theorem or proof, not even very good empirical evidence available. Well, we have plenty of evidence, as I suggested, of the demand for liquidity of some of these market-making activities. We have evidence of what has caused banking crises in the past, but these interaction effects are very hard to model. Also, our risk models are not very good. So a lot of you I know are doing things on risk modeling. Freddie is one of the world's experts. The empirical implementation of those models is way behind where they need to be to set these capital requirements. So they need to be very robust. Make them as high as you think, and then make them higher yet. Not ridiculously high. There is some cost, but right now I don't think we're overshooting on capital requirements by any means. Okay, so let's take the last few minutes for discussion. I have lots more slides, but it's more fun to talk. We have, not that many. A few minutes. Thank you.
So if you want to ask questions, you can use microphone and please state your name and your affiliation.
I don't need the mic. I'm loud. So I'm from. So I guess I'm thinking of the proposal from a practical standpoint. I've talked to a number of traders and bankers here. They all say they can deceive any regulator. In other words, they can have a hedge as a speculation or a speculation as a hedge. They say it's very easy to do that even to their own internal business. And so they say from the outsider's point of view, just even forget about it. Therefore, the point being that going to your figures, should we just go back to, since the regulators cannot regulate trading anyway, they can't do it. Let's just assume that it's impossible to do. Just why don't we just have this,
Universal.
Yes. That,
where is it? Yeah, universal.
It's impossible to regulate. That's what they, I don't know, maybe the traders here are smarter. How would you actually do the capital weight? Because if I don't even know, I can't measure what you're doing.
Well, this goes back to, again, work that Paul and Freddie and others have done on risk measures. We don't just give up. We don't just draw the circle and walk away.
Right.
We have to assign high capital requirements, and there are other requirements. I don't want to downplay things like disclosure requirements and fair trading requirements, protecting counterparties, lots of requirements, central clearing, all kinds of requirements. That's very important. Banking is a regulatorily intensive business. We shouldn't give up on that. But with respect to these activity boundaries, I would keep it simple as you suggest and raise capital requirements. And when estimating expected tail loss or value at risk or coherent risk measures for these activities, we need improved modeling and more robust empirical implementations where we don't just say the 95th worst percentile is take the last 1,000 days and take the 950th worst and we'll call that the 95 percentile. That's not good. That means that the last 3 years are about representative of the next 3 years. That's ridiculous. You've got to be much more robust than that. So I would be more robust about capital requirements and how you measure them. Sorry?
You have faith in the regulator?
Well, I have more faith than, I would rather have a regulator and pay them as you do in Singapore well and educate them well, which is what we're all doing here, than simply just walking away and not having any regulations at all. I don't think that's the answer. Yeah.
You did not mention actually the size of the bank. Okay. So
yeah.
You did not mention actually the size of the banks, because if you have, like in the United States, a huge amount of small banks, if some of them are failing, I don't care.
Really?
Yeah. If this is 10 out 1,000, the economy will not have such a huge impact. and a big bank failing, this is really systemic.
Okay, so that's a very good question, and that question has been raised a lot, particularly in the United States. So there's been a lot of discussion of how big should a bank be allowed to be. Many have suggested 100 billion. Some have suggested 500 billion. A few 1 trillion, and we have banks that are bigger than 2 trillion, like JP Morgan. So is that big? Is that really necessary to have such large banks? So, and how do we, if we think that's too large, how do we reduce the size? One proposal is to simply say 500 billion, that's it. No banks larger than that. That's not my idea of how to do this. My proposal is roughly what Basel III is doing. The bigger you are, the higher the proportionate capital requirement, because the bigger they are, the harder they fall. So they need even more capital, lower the likelihood of failure. They need failure resolution, which is very robust. So there's a lot of bail-in and other measures that are being used. The larger you are, the more you have to be able to demonstrate that you can fail somewhat more safely. But we shouldn't draw the conclusion that if we somehow get all the banks down below, say, 100 billion in size, then we don't have to worry about banking crises. Lots of banking crises happen as a kind of mass effect across many small banks, which are just as dangerous. In the United States, between the years 1929 and 1933, 5,000 banks failed. 5,000. Yeah.
Well, I'm Richard at Zurich. I think the Swiss, of course we know that some Swiss banks really were very badly hit. And I think the Swiss regulation is now going in that direction. I think they take proportionally much higher capital rules by the end of the next 5, 6, 7 years, I think. They go up even to 19% in some cases. So I think they, as far as I know, they try to go this way.
Yeah, that's right.
I don't know the details yet, in full details in my head. But
it's called the Swiss finish.
It's called the Swiss finish.
Yeah, so maybe it's not an accident. Maybe you and Freddie have been advising the Swiss regulators. In any case, I do think that's the way to go. Graduated high capital requirements for large banks is the way to go. And also, the Swiss banks have been allowed to use special bonds that are triggered to go away and become equity if the bank's capital levels go down below some high thresholds. These are called COCOs, and they're a great idea. And I think other banking jurisdictions should encourage them. They're not being encouraged in the United States, but they are in other places in Europe.
Ibrahim Ekran, University of Southern California. I have a question about European ring fencing system. I mean, I don't understand the use. If there are two separate cash pools, and if the fail of one wouldn't affect the other one, why would you keep it under one company? And if, I mean, the other way around, if the fail can affect the other one, I mean, I don't understand why there is a use of putting a fencing in the middle other than saying that you put it there.
Okay, part of it has to do with synergies associated with customer service. So Anand calls me and he says, I want to issue a bond. I say, fine, go talk to my people over in the underwriting division. And he says, well, I also want to bundle it with other financial services like line of credit, cash management services. I also want to swap my bond from fixed to floating. I want to do some underwriting activities. I have a lot of other things I want to do. And I say, well, I can offer all of those things under the name Standard Chartered or under the name HSBC. You only have to talk to me. I will handle all of these activities. I'll split them up among our various divisions. So these firewalls are meant to be invisible to clients and hopefully won't destroy operating synergies, client service synergies. They will only, hopefully, this is the hope. I'm not proposing this. I don't like it. But this is the proposal, is that it won't destroy the operating synergies and client service synergies. It will simply provide protection for the conventional bank systemic services like payments and settlements from risky activities that are in the global trading or wholesale banking area. The reason I don't think it's going to work is that what I already mentioned. If I'm offering these all to my clients in a way that looks like one brand, one franchise, and then someone reads in the Financial Times that I've lost a ton of money over there, they're not going to be trying to figure out where's the firewall, what kind of protection do I have. They're going to take their money out over here too. So the synergies are going to be a source of systemic transfer of risk through the firewalls, in my view. And they're expensive because it's cheaper, as most of you that have studied diversification knows, to get a certain measure of safety from pooling the risk together than from separating them. This is called convexity. Again, going back to Paul and Freddie's work, risk measures should recognize the benefit of diversification, and they do in their proposals through something called convexity. Jensen's inequality is an idea.
Guy Saxton, independent economist. You mentioned that a bigger circle is advantageous in terms of efficiency, but we've seen for some time now a big circle which includes these other activities which have been very, very profitable and certainly give the impression of oligopoly-like profits for some period of time. So a smaller circle then, and part of that oligopoly-like profits comes from the ability to leverage the balance sheet of the consumer bank through the funding and cheap funding and so on, because of the government guarantee. So a smaller circle then is more efficient in the sense that it can potentially promote more competition within the banking sector. I wonder if you could give your thoughts on that. So
the question is whether I agree with the comment about oligopoly in the large banks. So these G14 banks, the household names, Goldman Sachs, JP Morgan, HSBC, all of these banks, they have a small club which controls global market making and derivatives and securities in a way that makes it difficult for others to enter the business. They're being sued for this in today's news in Europe. There's been some discussion of this in the United States. So in my view, it is true that there are some oligopolistic distortions here. In fact, there are natural oligopolies associated with network externalities, one-stop shopping, economies of scale and scope that suggest this is a natural oligopoly that needs to be controlled. The question is, how do we control it? So one way to do it is to say, let's separate the risky trading and derivatives activities from the payments and settlement system. I don't think that necessarily is the most surgical tool for reducing oligopolies. So higher capital requirements for larger financial institutions, higher capital requirements where risky activities can infect the safety of other activities. These higher capital requirements themselves are going to punish banks that wish to grow very large, because not intentionally punish them, but it will reduce the incentive to grow exceptionally large. But it is true that there are these oligopoly issues. In my view, they should be dealt with by competition and antitrust kinds of regulations, rather than activity limits, which are, the way they're written and enforced, designed not to address oligopoly issues, but rather safety and soundness of banking activities. But I agree entirely with what you said, and I've said that in a number of places. An example of another way to approach this in the derivatives market is the new requirement, both in Europe and the US, that over-the-counter derivatives, which are standard, may no longer be provided to customers without competition. So in the old days, when Jean-Pierre called me for a quote on an interest rate swap, I give him my bid and offer, I do his business. Today, when he calls me, I say, I'm sorry, I can't do this anymore. Go talk to Anand's new swap execution facility, an electronic trading platform, which will provide not only my bid and offer, but the bid and offer of several people, which will compete for the opportunity for Jean-Pierre's trade. Now that's an oligopoly tool, which is not related to these issues, which I think is a very good idea. That's part of the Dodd-Frank Act, by the way. Dodd-Frank Act is very complicated, but it's got a few good things in it.
So we talk about the reasons for that. Now, going to the various regulatory solutions that have been discussed, right? They're all about starting up the systems and businesses,
Yeah.
right? So the reason for that and the crisis that caused it, was it indeed caused by these linkage? In other words, did the scientists following the remand, is there like clinical evidence that it was these cross-circle linkages that actually caused it?
There's a significant amount of evidence that it was not cross-linkages that caused Lehman's failure. It was two problems. Number one, lack of sufficient capital. So basically their assets became worth less than their liabilities. That's usually a problem. And the second problem was loss of liquidity. We don't have these, this kind of information for Lehman, but we're pretty confident that they disappeared over a very short period of time, in part because there was a reach to get cash out of Lehman as fast as possible, and that accelerated not only the failure of Lehman, but the suddenness of it created massive amounts of uncertainty in the financial system that caused knock-on effects associated with liquidity. And so a lot of these, where's my picture? A lot of these activities over here, underwriting, market making, and other trading, particularly speculative trading, tend to be associated with sudden losses of liquidity, and they don't tend to be associated with linkage effects across here. By the way, the arguments in favor of the separation are not really related to linkages, other than loss of capital. Capital is a common pool. Freddie?
Where would you put high frequency trading?
That's a great question. In fact, if we go to this picture, where's my picture? Here it is. The firm that provided these data to me has a high frequency trading division. And I said, well, are you going to suggest that this is offering liquidity to the market like market making? Or are you going to suggest, or are you going to give up and say, under the Volcker Rule, we won't be permitted to do this, we're going to get rid of it? Whoops. And they said, we haven't decided yet how we're going to argue this. And we don't know what the rules are going to say yet, so let's wait and see. So some of the banks have gotten rid of high frequency trading because they don't think they're going to pass the Volcker Rule test, whatever it turns out to be. Other banks are going to play wait and see. Right now, most high frequency trading, other than alleged market making, is conducted outside of the banking system, in hedge funds and special purpose broker-dealers. It's a great question, though, because it is arguably market making, because you're providing opportunities to others to trade, but it's pretty hard to say that you're there in order to service clients, in most cases. Yes, Robert?
The shadow banking system in the universal banking system.
Okay, so the current boundary of the U.S. banking system, which is kind of typical, includes a lot of credit provision outside of the banking system. So this kind of maturity transformation happens through hedge funds, special purpose finance companies. China has a lot of the credit provision outside of the bank. So does the United States. So it's universal banks doesn't mean that all credit provision happens inside banks. It means that banks are allowed to do all of these activities. So, and a lot of it will continue. Securitization, for example, is an example of a shadow banking activity that will continue on the outside of the banking system. Ivan.
Singapore has never had a bank failure. Is that a
Wow.
success or a failure?
Yeah, that's a very interesting question. Maybe you're playing it too safe here. I think probably the real test is not whether you ever have a bank failure, is whether you ever have multiple bank failures around the same time, or whether you ever have a bank that's so large that its failure would be a problem. Ideally, you would expect that every now and then banks would fail if you're operating at a kind of reasonable trade-off. But I don't know whether, the special case of Singapore, it probably means that you have a pretty well-regulated financial system, and you don't have a very long history either. You did have bearings here, right? Yeah. Well, you missed the commercial benefits of all the employment and money making that happened there. You missed the opportunity. I'm trying to list the benefits now. There obviously are lots of costs, but surely there are some benefits to having very active financial institutions inside Singapore as opposed to outside. More employment, higher paid salaries, knowledge industries, your provision of monitoring. Banking is a lot about monitoring, so provision of monitoring services to local borrowers. Where they had to borrow money from London or New York, they would have to pay higher credit spreads, because it's hard to monitor the quality of borrowers from that far away. I don't know whether you have such large borrowers that you need large banks, or whether they have demands for such, robust amounts of liquidity that they need large banks. But if they do, then that's another source of a benefit. Of course, on the cost side is when they fail, they usually fail big, and that's very costly. I'm a Canadian. Canada came through the last financial crisis quite well, in part because, like Singapore, we had a very good banking system, well regulated, and not too much dangerous practice in the shadow banking system.
I think my question is related to both this shadow banking system and as well as the capital requirement. So my question is, suppose we adopt this universal banking system and raise the capital requirement, would that push the bank, so this will might have increased the regulatory burden for the banks. So this might induce the bank to take more risk instead of reduce their risk-taking behavior. So would that make the bank more dangerous or safer?
Yeah, I've heard that argument a lot by banks. They say, if you raise our capital requirements, then in order to make up for the lower leverage, we're going to have to take more risk. Now, clearly there's got to be a disconnect there, because if the capital requirements are risk-based, then the more risk you take, the more capital you have to hold. And it's pretty hard to argue that when you have more capital, you're more likely to fail from risk-taking. Remember, the equation is not how much risk you take, but how much risk you take relative to capital. Why does the argument of the banks nevertheless have some appeal? It's because the risk-based capital requirements are not very accurate. So if you raise capital requirements in a way that doesn't correctly weight the risks of various activities, you could be providing an incentive to take risks that don't have a required amount of capital that's appropriate. An example, buying government bonds from weak sovereigns. Usually government bonds do not have significant capital requirements. In the Eurozone, for example, any Eurozone government bond issuer has the same capital requirement for a bank investment as any other Eurozone government bond issuer. Pretty hard to imagine that that's an accurate measure of risk-weighted capital. Yeah, so you can argue this both ways, but I would say I'm not worried about, at least if regulators don't do a terrible job, of raising capital requirements and causing even greater likelihood of failure. I don't think that's the case. I think when you raise capital requirements, typically you're going to lower likelihoods of failure. Ivan. Yeah, I agree. I agree absolutely. There's a little bit of co-opting here between governments and banks. So it could be that there's a wink and a nudge. If you raise our capital, then don't look too closely at where we're going to re-weight our risks. Because if you do, you might see we're taking more risks. And that kind of wink and nudge has been going on in Europe, where certain banks, large banks in certain countries, just to the east of France, have been changing their risk weights in a way that with higher capital requirements is not raising their capital requirements very much. And you're right, they should have been doing that before if it was legal to do it, but I think there's a certain amount of cooperation between bank regulators and banks in certain countries that allows that sort of thing to happen.
I just thought that Warren from the MAS had a follow-up question to that on capital requirements. What about the argument that they make that if you make it so expensive for us as banks to pursue these activities that people will just find a way to pursue it via the shadow banking route, so where it's cheaper because you don't capture it?
That's a similar, I agree with that argument. It's similar to the one that I made of if you push risk-taking activities by activity limits out, then they're going to occur on the outside and they might be riskier there. So that argument is similar to the one that I'm making. Both of these, if the Volcker Rule goes through, and it probably will with, well, it's already law, but if it's pushed through with strong, aggressive, anti-risk-taking measures, something is going to have to be done in the shadow banking world to protect the shadow banking world from that new source of risk. And the same thing when you raise capital requirements for banks pushing risky activities to the outside, you have to add additional supervisory macroprudential and microprudential regulation of the shadow banking system. This is what China should be doing right now, so as to make that a safer place too. So higher capital requirements, access to the central bank where it's a big activity whose failure could cause a systemic damage, and strong supervision. That all is needed in the shadow banking world. And people say, well, it's shadow banking. It's kind of the same point that Anand makes. You can't keep track of it. It's just too complicated, and it's kind of like what Americans call whack-a-mole. You know, it pops up here, you whack it. It pops up there, you whack it again. I think the answer is you just keep whacking, and when you see the moles get bigger, you try to plug the holes before they come out. And so basically, follow the money, follow the risk. And big risks are not that hard to find. And when you see it developing, you stop it. Like, again, like the shadow banking in China, like People's Bank of China tried to do on June 20th. Wow, lots of good questions. By the way, I have a nice, easily accessible essay about this on my webpage if anybody wants to read it, that I wrote for the World Economic Forum.
Hi, I'm Ernest I'm from the public.
Uh-huh.
Yeah. So far, a lot of the policies that you have proposed involve the banks. But what about the customers of the banks, like ourselves? In the event that we hear that, for example, a bank has lost millions of dollars in liquidity, do you think there should be a policy that should stop us from withdrawing all our money at one shot?
Uh-huh.
Yeah.
This is what Cyprus did recently. There are cases in which this is the right thing to do. Sometimes this is called a bank holiday. Sounds good, huh? That's why they call it. It's the government. They always call things that sound good, even if they're not that good. But bank holidays are sometimes necessary. So in the United States, during the period I mentioned, 29 to 33, in order to stop a national bank run, they declared bank holidays from time to time, where you were not permitted to go and collect your money. Cyprus recently had a bank holiday. The problem in Cyprus was not so much stopping people from going to the bank to get the money. It was telling the depositors, we are going to take away your money to help resolve the bank. That only encourages a bank run. As soon as you stop the bank holiday and you open the banks, you're basically telling people, you should get your money now because we may take it away if you don't. That's bad news. So, yeah, I think it's okay from time to time as a last resort to prevent people from getting money out of the bank. That's very similar. It's very annoying, though. If you watch television during the Cyprus crisis, people were going back to the bank and standing in long lines every day to get $50 or $100 out of the or euros out of the ATM machines. But it was a trade-off. You want them to have no cash. So it's called gating, by the way, and it's also used by hedge funds when they are having liquidity problems. They have a contract with their clients that say there are limits on how fast you can redeem your money. And those contracts are designed to mitigate liquidity costs for runs and the damage to the hedge fund. When you consider the public damage associated with bank runs, I think it's a necessary last resort to be able to do this. hopefully it doesn't need to be used in any major banking system.
So, I'm Jean-Pierre.
My customer.
So, after your predatory activity on my 50 billions, I'm allowed to a light note. Where do you put Bitcoin in your picture?
Bitcoin. That's very interesting. Does anybody know the name Winklevoss? Okay, so this is the twins that allegedly came up with the idea of Facebook. And their latest, the twins' latest episode is to provide a market-making service for Bitcoin. Now, maybe some of you don't know what Bitcoin is, but I bet most of you do. It's an electronic currency, which regulators have some concerns about, but so far it's not big enough to be a big deal. These Winklevoss brothers are going to convert their own holdings of Bitcoins into ETFs, exchange-traded funds, to provide market-making services in Bitcoin, or synthetic Bitcoin through ETFs. I think it's fine. It's not. I mean, if you're going to have Bitcoin at all, allowing it to be traded is a good idea. We need regulation. ETFs are regulated. They are applying to the Securities and Exchange Commission for the right to trade, and then they will be subjected to all of the normal securities trading laws. I have a Stanford undergraduate student who, if anyone's interested, send me an email, I'll send it to you, wrote an essay which several months ago understood that Bitcoin trading should be regulated like a securities trading activity. And I agree with him. So I think it's okay. And if Bitcoin becomes very large, then it will be time for U.S. regulators to say this is too much like money and it's not efficient for the United States to have two monetary systems. So it's going to be crushed down to a reasonable size. Right now there's about $1 billion worth of Bitcoins available at the current price, which is $100 a piece. There are 11 million Bitcoins in existence, and there could be as many as 21 million. I'm told by the people that write the mining algorithms that it's impossible to mine more than a total of 21 million for some computational reason. So we have a lot of computational experts in the audience who can tell me why it is that computations run out, the computational ability runs out when you get to 21 million and not 19 million or 25 million.
I guess we have only about 2 minutes left, so I'm going to ask the last question. Take liberty. Okay. So I guess in talk you portray me as from government, so I'm going to ask a question from government viewpoint. So we have this shadow bank crisis and all this short-term lending crisis right now in China. And China did well during the last crisis, 07, 08, no problem. So what kind of advice you can give in terms of both policy issues, both long-term and short-term, and also in terms of building financial infrastructures, short-term, long-term ways?
Good. Well, I'm going to be talking about exactly that at a conference next week in China. And one of the reasons that China has not had a big problem during the last financial crisis, like India, is that its financial system is not yet a large global capital market-based financial system. It is a local banking-based financial system. China needs to have a large global capital markets-based financial system in order to continue to grow and reach its potential. In order to do that, as you suggested, it's going to need strong infrastructure. So, central clearing for derivatives. I'm going to visit the Shanghai CCP on Tuesday. It's going to need tri-party repo markets for handling bond financing. It's going to need various kinds of collateral services. It's going to need securities lending services. It's going to need a decision about what to do in terms of allowing banks to conduct these activities and reduce capital requirements. It's going to need, obviously, currency convertibility in order to be able to trade globally. It's going to need a large bond market because China's currency will not become a global trading currency unless foreign investors can store their money not just in bank deposits, but in long-term fixed income securities of high quality. It's going to need a lot of counterparty credit risk and credit risk analysis. It's going to need a lot of smart, educated people. I see this quite a few students here from China, some of whom I met earlier this week. It's going to need a lot of experts. So that's part of the infrastructure, human capital, a lot of experts in China who know all about financial modeling and banking. So it's going to need everything. And it's going to have to happen pretty quickly because I understand China is going to become a global capital markets power in the next 10 years. That means very fast growth in all this infrastructure.
Okay, thank you very much for that.